Hello, my friends. Brett Pattison coming at you from the financial capital of the West Salt Lake City, Utah, joined by the chairman.
How you doing?
The husky fella. I'm doing great, Brian.
Doing
It's great to see your face.
good.
We got a lot going on in the market, though.
Yeah.
Let's talk about the market, because it is volatile. If you watch the VIX, you know we've been in a VIX range of over 30 for a few weeks now, which is not common. So a lot of volatility in the market. Here's a market update. As of right now, the S&P 500 on the year, and today's a good day. The market's up almost 2%. Could be a bear market bounce. We don't know.
Right.
But the S&P 500 is up down 10.6% on the year. The NASDAQ, which finished down 20% yesterday, is down 18%. Really, really, really ugly market. So the question that we're getting right now, Brian, is with this market acting the way it is, right? And I mentioned this could be a bear market bounce, right? Call it a correction that we're in, or call it a bear market. Who cares? It feels like a bear market.
Mm-hmm.
What do we do now? What do clients do now?
Yeah, that's the $1 million question.
Yeah.
Right. And I think people are nervous. I had a client yesterday basically asking me, should we have more cash on the sidelines? Worried about a correction.
Okay, so let's tackle that one right now, because that's a question we're getting a lot. Should we sell some of the stocks that we own and move people more into cash, because the market might go down from here, or it might go up? But either way, it's scary.
Right. And Katie just asked that same question, and my answer is yes. You should have cash. You should have cash on the sidelines for your current needs, probably for the next year or two. You shouldn't be invested in stocks if you might need that money in the next year or two. If you're investing in a business, investing in a stock, or even in real estate, those are long-term investments. So you shouldn't mix the two. So I don't believe that. Hopefully, you have enough cash for your current needs and your long-term investments. I personally am not selling. I'm personally, looking at this as a long-term opportunity to pick up good businesses at really attractive prices.
Okay, let's dissect what you just said.
Okay.
If you need cash, you should have prepared a year, 2 years ago, 6 months ago, for what we're dealing with now.
Yeah.
For every client that has income needs, will hold, and they're using their investment account for those income needs, will hold 2 years worth of cash.
Right.
Specifically for markets like this. But if you're staring at today's market and you're saying, I want cash because I'm scared, and you don't have the cash put aside, what would you tell people?
That's a good.
They don't need the cash. They got plenty. They're just scared.
Well, then I don't think you need to do anything.
Then be patient.
Just be patient, right? I had a call last week from another customer saying, hey, I have an RMD this year out of my IRA. RMD is required minimum distribution. And I see that, I don't have that much cash in my IRA account. And I told him, I says, well, you do. We have short-term bonds, which is a cash equivalent, and to fulfill those needs. We don't want to have to sell stocks for income needs when stocks are down, when prices are down. We actually want to do the opposite. We want to buy when the prices are attractive, and prices are much more attractive than they were 3 months ago or 6 months ago.
So people, all right, I just want to get this cash. I want to make sure I understand this cash thing. Make sure the people at home can understand this cash thing. You plan for 2 years worth of cash needs. In our office at Iron Gate, we put that RMD into that 2 years worth of cash needs. We calculate it for people, and then we put that to the side, whether it be in cash or short-term bonds, same thing.
Right.
But people that have cash right now, you're saying, don't sell, buy.
Yes.
Why? How can you do that right now, Brian? The market's inflation,
it's scary.
Oil, war,
right?
China hates us.
Yeah, I think for a lot of people, it's scary.
Everybody. It's all hell's breaking loose.
Usually, the best opportunities in the financial markets is when there's the most fear. And the reason why is because fear creates selling. Selling creates better, prices, cheaper prices or lower prices, and that usually is represented an opportunity to buy good businesses. When you look in the rearview mirror 2 or 3 years, 5 years from now, saying, "Wow, that was a good opportunity to buy good businesses when prices were way down." That doesn't mean that we know that stocks are going to go up tomorrow or in the next 3 months, or even for the year. We don't know that this will be a positive year. So far, you just gave us the numbers.
It's been the worst start to a year in the history of the stock market. That's how good it's been. It's been terrible.
Well, it's 2020 was worse with COVID. Right?
Yeah, but January 1st, we started falling, right? We went up the first of the year, and then went down in 2020.
Right.
So to start, semantics.
Right.
Sentiment right now is the worst it's been since the great financial crisis. And I mean, the fear is insane. And you're telling me that's the best time to buy.
Historically, that's been the best time to buy.
Let me throw
when prices are down, you're buying. So when you buy a business, you're looking for that business to create value and create wealth for you. And the way that it does that is by increasing profits and revenues over time, investing money back into the business and growing profitability over time. And so when prices are down, if you have a good business and is doing those things, investing in the business to generate more income, more revenue in the future, that's a good opportunity. But in the meantime, stocks can be volatile. Not can be, or they are volatile. They are volatile.
Volatility is the price you pay for good returns, and we've said that time and time again. Let me throw a couple numbers at you here, Brian.
Okay.
You're going to love this. And I'm just going to throw some negative years at you. And this is the S&P 500. Minus 17, minus 17, minus 13, minus 34, minus 19. Let's see, minus 10, minus 16, minus 19, minus 20, minus 34. We're not even close to 34 right now.
So those are market declines.
Those are market declines in given years. But guess what happened every one of those years? The market was positive on that year.
On those years.
So if we're looking at the stock market for some sort of comfort because we're scared, we're looking at the wrong thing.
Yeah.
Right? You can't look at the stock market for comfort. That's why we love the stock market. It provides these opportunities to buy great businesses, not stocks, businesses at great prices, which is what you're talking about.
Yeah.
Because since 1924, there's been 59 corrections. Okay, a correction is between 10 and 20% down. Every one of those corrections led to new all-time highs in the market. That's amazing. Is it going to fail this time and the market's never going to reach a new high? I don't think so. It might take time.
History would suggest otherwise,
Yep.
and the probabilities would suggest otherwise.
Correct.
I've said this before. You said it. That historically, every correction has always been temporary. We've never had a permanent market decline, or it just never recovers. And we talked about the reasons why. We don't need to go into that now. And so I believe that to be true. I always think about it personally, and I try to teach our clients or discuss this concept with our clients, is that you really need to think as like a business owner, and think in terms of long term. I don't need this money tomorrow. I don't need it next year. I need it 3, 5, and 10 years from now. For me, I'm in my late 50s. This is a real issue. Getting old. But thinking about retirement in the next decade or so, and
15, 20.
Next 10 to 20 years.
That's better.
But yeah, thinking about it, those are real issues for me.
Yeah.
And but 10 to 20 years is a long time.
Yep.
And so I'm willing to willing to invest in these businesses over the next 10 or 20 years. I believe I will be well rewarded, and our clients will be well rewarded by owning great businesses over a long period of time.
So for clients that are a little nervous about the correction, right? If you have a financial plan, you've met with Spencer or Matthew, reach out to them, because a lot of people find comfort in reviewing a financial plan, which tells them if they're on track or not, rather than looking at the actual balance during a correction of their investment accounts. So I would say reach out to them and review it, because that's the plan. That's what you're trying to accomplish. Are you still on track to accomplish those goals, even in the midst of a correction?
Yeah.
Okay? If you don't have a plan, you got to get one. If you're sitting there saying, I don't have 2 years worth of cash needs put to the side, well, that's because you have no plan. So reach out to us. We'll put you in touch with Spencer or Matthew, and they'll start that plan with you.
I heard Buffett say, I always have to bring up Buffett.
Yeah, you do. And that's okay.
That's okay.
That's okay.
He said, you shouldn't own stocks if you're going to do stupid things when stock prices go down. And that sounds maybe rude or insensitive, but really, you should think about, when you own a business, you should think about, I'm going to own this business for 5 years. If you're debating right now, gosh, if it goes down another 5%, I'm going to sell, then you shouldn't be in stocks.
Then you have no plan. You shouldn't be in stocks.
They shouldn't be.
Yeah, absolutely.
They shouldn't be. If you're debating, if this gets worse, I'm gonna sell. Then you're really thinking about it wrong. You own a business. It just happens that it's a publicly owned business. It's traded every day. You get a price quote every day, and that's the negative thing about owning publicly traded stocks. If you own a piece of real estate, a private piece of real estate, piece of land, something like that, you don't get a price every day, even though what a person may pay for that business may change every day, but you don't get a price, and that creates a lot of fear for a lot of people. They think, oh, it's down 10% so far this year. I mean, it's going to be down another 10% in a month, and their head starts spinning. Unfortunately, that's not helpful. You shouldn't think like that.
So what is the advice to people that are watching the news, reading the news, and they hear about, the war, Ukraine, Russia, potentially China and Taiwan, who knows? Oil's at $120 a barrel, and we've never had oil above $100 per barrel without there being a recession. I think it's something like 7 for 7 or 8 for 8. What do you tell those people? There's just a lot of fear out there, not just market-based, but globally. Tons of fear.
Yeah. Well, as far as the recession, maybe tackle these individually. Recession, they used to happen every 3 years or so. They don't happen nearly as often as they used to.
Because the Fed,
keeps pumping money into the system, and
which they can't anymore.
Right.
So is a recession a bad thing? What is a recession defined?
It's 2 quarters of negative gross domestic product.
So we still could have positive. It just is lower quarter over quarter.
2 consecutive negative GDP growth.
Okay,
that's the definition of recession. They happen all the time. It's not anything to get super panicked about.
It could be priced in the market right now.
A lot of times the market sees it coming and they start pricing. In fact, I think the market is the probabilities, like you talked about, because of oil prices are so high. And then the war, that's the fear factor, and that people may pull back on their spending. My son just the other day said he saw the price of, how much it cost to put gas. He came back putting gas in the car and he says, I can't believe how expensive it is. I need to stop driving as much,
That's why high oil prices lead to a recession, is what your boy just said.
Yeah, he said that.
He's going to stop driving, stop spending.
I think a lot of people will limit their driving, and that's a recessionary, impact. Has a recessionary impact.
I think the probability of the market's pricing that is around 30 to 40% right now.
And I heard some comments today about this very issue. Recessionary probabilities are always about 20-25%, even in good times. So it's only up about, it's only gone from 20, and that was even a month ago or 2 months ago. It's gone from 20-25 to now it's 30. So yes, it's gone up somewhat, but there's always a chance of recession around the corner at some point. It's not any reason to say I need to sell stocks. I need to sell my businesses because there's a recession coming. So that's what I'd say about a recession. And the other thing about a recession is it's kind of a reset. A lot of times there's excess in the system, in the financial system, excess debt, excess
needs to be flushed out,
and that kind of flushes the system and kind of resets us for new growth, and you get new businesses formations, and so recessions they happen. What happened in the financial crisis is different. That was a recession, but that was a bubble bursting in the real estate market that just trickled throughout the domino effect throughout the whole system. That was not a typical recession. That was almost catastrophe.
So what I'm hearing, Brian, to kind of sum up the conversation, for those that are fearful, which most people are, you're saying just stick with the plan that we have with clients. You've got your 2 years worth of cash, which, by the way, average bear market going back to the early 1900s is 14 months. We've got 24 months worth of cash, plenty of cash to get you through the average bear market. You got the cash, stay disciplined with where we buy stocks. That's to summarize it. And be patient.
Yeah, I mean, we didn't really discuss the war. Yeah, that's really it. But if you want to discuss a little bit about the war issue,
tell me what Putin's going to do next.
Yeah, I mean, I mentioned on the phone yesterday. Who knows? I'm not in Putin's head. And the client said, I wouldn't want to be there, be inside of his head.
No,
that'd be kind of crazy.
No,
but we have no idea what's in his head, what he. What is he going to do? And so that's, there's a lot of uncertainty there with what he's going to do.
Yeah.
I'm hopeful and optimistic that we'll find a solution and that, we can move on from this. It's a sad situation. But again, if you own a business, you own a farm, you own some real estate, say it was privately owned, you're probably not going to sell those assets, even if Putin does something even crazier than what he's already done. So I feel the same way about if we own some great businesses. Again, yesterday conversation with a customer and the question was, do we need to raise more cash? And I said, well, I'm looking at your portfolio and are we well situated if we have a recession or if there's an economic impact, financial impact? And I said, I love the businesses we own. We own some incredible businesses, I believe some of the best in the world, and I feel very good about how we're positioned going into an economic downturn, a financial downturn.
Yeah.
These are great businesses, some of the strongest businesses in the world. So I feel very good about it. That doesn't mean, we know what the market's going to do tomorrow.
And the optimist will triumph. Here's the beautiful thing that we're able to do, though, during volatility for a segment of our clients, and that's the options trading. I have traded more options, 56 trades. I just looked at it. 56 trades, half of which are still open, the rest closed. Last year, I didn't make 56 trades. So because of the volatility, the whole year, because of the volatility, we're able to make a lot more option trades, which is geared towards producing more income for clients. If you can create, 2 to 6% of income, like a dividend for the entire portfolio because of the volatility, take advantage of it.
Yeah.
That's not going to turn a down 10% portfolio to be positive, but it's going to certainly help, especially as the tide turns, or replenishing cash for people.
Right.
Either way.
It's really the same concept we talked about with stocks. The only difference is options is shorter window.
Yeah. Lot shorter.
And you see a lot shorter, and you see that income coming in right now.
Mm-hmm.
With stocks, the volatility also creates opportunity. Same as options. It just takes time to see that pay off. But to summarize, we look at this as an opportunity to pick up good businesses
mm-hmm.
or great option trades opportunities when there's market volatility and lower prices.
Yep. So as long as a client has a plan coming into this, and then we could take advantage of volatility while it's occurring, that plan's going to get them through it. And you heard, since 1924, 59 corrections have all led to new all-time highs in the market. How awesome is that?
Yeah.
So if you have extra cash that you don't need, call Brian. He'll put it to work.
I mean, even if 2022 isn't a positive year, I mean, so far we're down this year, and there's a chance that the market could be flattened, down for the year.
Yeah.
I do believe that looking ahead 3-5 years from now, that we'll look at this as this was a good opportunity to put money to work, to buy good businesses, and so that's what I think.
Yep. What's the probability that we're higher 5 years from now than where we are right now?
I think it's pretty high.
Like 90%.
I don't know that
91.
I don't want to put a number on it, but I think it's
a lot.
It's pretty high. I'm willing to bet that I'd be willing to bet, and I have
I'd put 90% on it.
Okay.
I'd take that trade all day long.
You think about we call it the rule of 72, right?
Yep.
And that's how long it takes your money to double at a certain rate of interest, divided into 72. So if you get 10%, 10 goes into 72, 7.2 times. So your money would double every 7 years.
Which is the goal.
Yeah. And so, if over the next decade or so, I would expect markets to double approximately over the next decade. That's assuming prices are rationally priced today, kind of the starting point looking out 10 years from now.
Yeah.
And I think stocks are. I think stocks are rationally priced. And of course, interest rates, I look at interest rates at, where they are. The 10 years now about 2%. And I still think that's pretty low. I think if we see even 3% interest rates, I don't think that's going to kill the market. It might be kind of a bump in the road for a time,
but some of that's already priced in. You could argue too.
Right.
Yep.
Yeah.
It's the goal for clients is not income and it's not growth. The goal should be growth of your income,
mm-hmm.
right? That's the goal.
Yeah.
And that's what we're shooting to accomplish for clients through stocks, through options,
owning businesses,
great businesses, not stocks. I just said. Yep, I worded that wrong, didn't I?
I don't like the word stock.
Business is options. Amen, brother. Thanks for coming in today.
Yeah.
Great to see everybody.
Yeah,
just you, Katie, because no one else is here. Until next time. Bye now.